Good morning. Today we're going to cover part 2 of chapters 11 and 12. And notice that there's some pages in each chapter on information technology. While that is important and beneficial for you to read, we're not going to cover it in this class. So I suggest you read it and study it as much as you want, have time for it. It's good information. It's just we're not going to spend time on it in this class. It won't be on the test. COSO's 5 components of internal controls. We're going to go through those. I think the book spends too many pages on them. I'm going to show you what I think is important. I think you should read all of it, but study what I am stressing. Make sure you information and communication system. Accounting is part of the information and communication system. The control environment, the 2 elements of the control environment, which I think are the most important, are the integrity of management and the role of the audit committee. Nothing is more important than the integrity of management. I'm convinced that if a client wants to lie, cheat, and steal, it's very difficult for the auditor to detect misstatements. If management is trying to produce financial statements that fairly present the results of operation and financial position, then I think the auditor can have a successful relationship. So nothing is more important than the integrity of management and the values of the company. The board of directors. Now, for a public company is required to have a board of directors, and they're required to have an audit committee. The board of directors breaks up into different committees: the executive committee, the audit committee, the management committee, whatever. The audit committee is required for public companies, and it's required to be comprised of outside directors who are not employees of the company. So the CEO is almost always on the board of directors. The CEO is not allowed to be on the audit committee. Many times the CFO is on the board of directors. The CFO is not allowed to be on the audit committee. No employees of the company are allowed to be on the audit committee. They must all be outside directors. In fact, for a public company, the CEO and CFO are not allowed to attend audit committee meetings unless the audit committee requests their attendance. The audit committee appoints the external auditors. The internal audit reports to the audit committee. The audit committee resolves differences between management and the auditors. And the audit committee must approve all non-audit services provided by the auditor. What's that mean? So EY does the audit of the client, and the client also wants EY to do their taxes. The audit committee would have to approve that non-audit service. EY has a consulting program that the client wants to purchase. The audit committee would have to approve those non-audit services. Risk assessment. Now, it's really important here that you understand risk assessment, as we're talking about it today, is how does the client manage risk? This isn't 315. This isn't the auditor's assessment of the risk and material misstatement. This is how the client manages risk. Remember the definition of internal control. The first part of that definition, a process affected by those charged with governance and management, designed to provide reasonable assurance about the achievement of the entity's objectives. That's the first part. Reasonable assurance about the achievement of management's objectives. Okay, so that objectives is an important word here. I don't think we do a good job in the business curriculum of talking about risk. The first thing is to stop and think, whenever the expected rate of return is greater than the risk-free rate, you can assume, you better assume, that the investment is not risk-free. So whenever the expected return is greater than the risk-free rate of return, there's risk involved. That's what business is. Business is about managing risk. Tad's very risk averse. I just put my money in an FDIC insured savings account. I don't have much to put in there. That's probably why. Companies, on the other hand, invest in risky assets. And the auditors must understand how the client converts those risky assets into cash receipts. Now, what's the definition of internal control? Provide reasonable assurance about the achievement of the entity's objectives. We need to understand how the client sets their objectives, what those objectives are, and how they set them. So COSO not only has a framework for internal control, COSO has a program for a format for enterprise risk management. So not all clients would use it, but let's pretend this client uses COSO's enterprise risk management format. Now notice 1, 4, 6, 7, and 8 are very similar. The environment risk assessment control app. They're very similar to the components of internal control that we're talking about right now. But if we look at 2, 3, 4, 5, that's all about objective setting and risk. So number 2 says, how does the client set their objectives? What are their objectives? How did they set them? Number 3, how does the client determine whether they're on track to meet those objectives or that doesn't look like they're going to meet those objectives? Okay. Number 4, how does the client assess the risk? Okay. So, and number 5 is if they're not on track to meet their objectives, how do they respond? Okay. So I think it's really good when we talk about risk assessment. How does the client manage risk? You don't have to memorize these steps, but I do think it's important to realize, wait a minute, we better understand, if we're going to talk about reasonable assurance of achieving their objectives, we need to understand their objectives, how they create those objectives, what meeting those objectives, how they measure their progress toward those objectives, and how they respond. So I like this little box. You don't have to memorize it. I just think it's helpful to focus. We're talking about how the client manages risk. Control activities, the book lists a bunch of them: adequate segregation of duties, proper authorization of transactions, and adequate documents and physical control over assets and records. Okay. So I think you read them, but we're going to talk about 2, segregation and duty and adequate records and documents. Now, I'm intimidated by internal control. So I'll fess that up right away. But I want to stress one thing here. Think of the simplest cases first and then expand it. Okay. So locks on doors are a control. The car dealership I worked at in Tucson, when I worked there, there was a big open lot. There were probably 100 cars sitting on the lot. People could wander around and look at them. When I drive by today, there's a fence, and there's probably only 5 or 6 cars outside the fence. The fence is a control. So controls can get very, very complex, but try and think about simple controls to get your head around it. We're going to talk about segregation of duty and adequate documents and records. Now look at here, we've got authorization of transaction, documents, records. And I want to go for a minute to way back in the body of AU 315. We just talked about the objective, but in the body, it says an accounting system are procedures by which transactions are initiated, authorized, recorded. So those words appear a lot. And when we talk about an accounting system, we're talking about how are transactions initiated, authorized, recorded, processed, transferred to the general ledger, and then transferred to the financial statements. So it used to be that every introductory accounting text started out, accounting is a system whereby transactions are initiated, authorized, recorded, processed into the general ledger from which the financial statements are prepared. So those words that we just saw are kind of initiated, authorized, recorded. Beat those words into your head. Okay. Segregation of duties. It's important that we segregate duties. So I'm going to start with the bottom one because it's kind of a new one. We're going to segregate user departments from IT. User departments from IT. And so that's a new one. Why do we need to segregate IT from user departments? Well, back in the day, so Tad has a $20,000 credit limit with the company's parts department. So Tad goes in to buy parts. In the old days, somebody would have to check, does this put Tad over his credit limit? Tad already owes us $15,000. He buys $7,000 worth of parts. That exceeds his credit limit. Somebody used to have to do that. Now that's probably embedded in IT in most companies. So Tad comes in, he orders $7,000 worth of parts, you key in the order, and all of a sudden a red flag shows up, and so that would put Tad over his credit limit. So many controls today are embedded in IT. So we're going to segregate the IT department from everybody. Okay. Then we go back to the basics, authorization of transactions. The person that authorizes transactions should not have custody of the related asset. The person that has custody of the asset should not have record-keeping responsibility or accounting. So if I'm in charge of inventory, I shouldn't be in charge of accounting because then if there's a shortage, I could cover up the shortage. Record keeping from operational responsibility. So we don't want the sales manager, who undoubtedly has lots of incentives based on sales performance, to also have responsibility for the accounting for sales, right? Because he would have great incentive to overstate sales. So those are the four. Those are the new ones. Those are what you want to learn. The old version of segregation of duties, which I should just scrap, but I can't because I learned it, is authorization of transactions should be separated from custody of the assets, should be separated from the accounting or record keeping. I think that pretty much covers the three new ones. But back then, IT didn't play such an important role in control, so that's why IT was not on there. Adequate documents and records, pre-numbered documents. When I was a service manager at a car dealership, I was always frustrated that they made me pay extra for pre-numbered documents. It cost quite a bit more, but now I understand why. So if we look at the checks, they're pre-numbered. You all have a checkbook, 22, 28, 29, 30, 31. When we look at the cash disbursements journal, it's very easy to see there's a check missing. That relates to the completeness assertion. Cash disbursements will be understated. Cash will be overstated. So make sure you understand why it relates to the completeness assertion. Make sure you think through why, if cash disbursements are understated, cash will be overstated. Spend some time thinking about that. Information and communication. This is the accounting system. And accounting, how do we communicate with the outside world, with investors? We prepare external financial statements. In 215, you talked about reports you would prepare for internal use, for monitoring the company's operations. And then monitoring uses those internal reports. Monitoring also relies on internal audit. We're going to compare the internal reports from 215 to our knowledge of what's going on in the outside world. We're going to monitor customer complaints, vendor complaints. Are we paying on time? Are our customers paying on time? We're going to look at any regulatory reports, and we're going to periodically reconcile the cash account to the bank statement. We're going to reconcile the accounts receivable subsidiary ledger to the accounts receivable control balance. We're going to reconcile the physical inventory to the recorded inventory balance periodically. So those are all steps in monitoring. Tomorrow we're going to talk a bit about understanding the accounting system. Thank you and have a good day.